So Tom's one of the outstanding on this, Greg. I pinged Gina, but it looks like he can't do anything till Monday anyway. And then the other two.
Okay, good afternoon and welcome back everyone to our third webinar on our Nasdaq-100 Index Options series. I want to thank Nasdaq for having me back on doing this very special webinar. I'm quite excited to share with everyone this specific topic of leveraging technical analysis with Nasdaq-100 Index Options because it really combines my life's work as a market strategist. I spent the first few years of my career doing a lot of technical analysis as a Forex trader. Any of you that have ever traded currencies are probably familiar with using charts from those markets. And what it combines that with is option strategies. I spent the second half of my career really learning about option strategies, trading option strategies, building options tools. And today what I really want to show you is the power of options when you're combining them correctly with technical analysis. There are some caveats to that, so I want to make sure I addressed all of those things. For those of you that have traded the markets over the last few weeks, I'm sure many of you have probably focused some of your attention on the Nasdaq-100 index, perhaps an index that maybe you didn't pay a lot of attention to before, but over the last few weeks, I think many of you probably have been looking at this because you're seeing more than double the moves in tech names versus just the overall market. And what this does is it provides a lot of opportunity for technical analysts, both from a trading perspective, also from a hedging perspective, to use an index that moves as much as it has over the last few weeks to find some opportunities. So we're going to explore some of those today. And I just want to introduce myself. My name is Tony Zhang. I'm the chief strategist here at Options Play, for those of you that don't know who I am. And today what I really want to do is provide some perspective because as many of you that use the charts for your trading or use technical analysis, you know that you spend quite a bit of time analyzing all of those charts. But what I really want to spend more time on is really understanding how to utilize those charts to provide trading strategies, because you don't make money from studying the charts. You certainly don't make money from using technical analysis. You make money from your trading. So what we want to do is understand how you can manage your trades, and more importantly, how can you manage your emotions when you're trading? And that's really where options comes into play, because options can really help you structure your trades beforehand to hopefully help remove some of that emotional side of trading once you're in that trade. So today we're going to break down technical analysis. I want to provide you some tips on how to keep technical analysis as simple as possible so that you're not sitting in front of a screen with too many indicators, how to find signals from those indicators while cutting out a lot of the noise. I will be covering a lot of different forms of technical analysis or a lot of different methodologies. I obviously can't cover all of them simply because there are literally infinite number of ways of analyzing a chart, but I will go over the broad categories. And what I want to show you guys is what form of options trading or what type of option strategies are suitable for different forms of technical analysis. And what I'll do is I will show you some real examples after the presentation using Options Play of Nasdaq-100 index and showing you how you can play different views of the underlying index with different option strategies. This webinar is going to be recorded. The slides are also going to be available to everyone afterwards. We'll try to get that out to you as quickly as possible after we finish this. So this webinar is recorded for those of you that are brand new. Definitely take a look at the slides and the recording after you're done. So I'm just going to leave this disclaimer up here for 1 second before I talk about which topics we're going to cover here today. Essentially what this is telling you is that this is not a solicitation or offer to buy or sell any securities. This is simply done for educational research, education and research to show you guys different forms of technical analysis and what type of option strategies are suitable for each one, because there's so many different forms of technical analysis. We just want to make sure that you guys are using it correctly. So first, I'm going to start off like we do with these webinars, just a little introduction about the Nasdaq-100 index options. For those of you that have not traded this product, I want to make sure everyone's familiar with what it is, how you can trade it. Then we're going to jump over to technical analysis. I wanted to talk a little bit about what is the value of technical analysis, because a lot of people use the charts, but I think some people sometimes may misunderstand what technical analysis provides. So I want to go over that. Then what we'll do is we're going to dive into what option strategies you should be looking at if you're using technical analysis. I'm going to cover three of the major or three of the most popular trading strategies that you can deploy with technical analysis. I'll cover a little bit about best practices for each one. This is not a deep dive into the option strategies themselves. We have quite a few webinars separately on that. But what I will cover is chart overlays. So for those of you that are looking for chart patterns and chart overlays, chart indicators, a lot of you use indicators like RSI, MACD, stochastics, very, very popular form of technical analysis. However, I do see a lot of people using them incorrectly with respect to options trading. So I want to address that. And then what I want to talk a little bit about is some of the tips that I have discovered as a market strategist to show you how you can use leading and lagging indicators to really help you cut out the noise and find the valid signals that you should be really looking for, and providing you with some tips and some best practices for how to use technical analysis, and also at the same time simplify your life a little. And then what we'll do is we'll end this by using some real life examples using options play, showing you the Nasdaq-100 index, looking at a few different opportunities, and show you how you can structure an option strategy off of those views using technical analysis. So let's just jump right into what is the Nasdaq-100 index option. For those of you that have never traded options or index options before, the Nasdaq-100 index itself is an index of the 100 largest non-financial stocks listed on the Nasdaq stock market. So there are two indices that you can trade. There's the NDX and the NQX. They are identical indices. Just one is a full value index, which is roughly about 7,000 as a contract value currently. And then an NQX, which is 1/5 of that, or about 1,400. And these two, like I said, these two indices are exactly the same. They track the exact same index. Just one is 1/5 the value, which is a smaller contract size for those of you trading smaller accounts. So for many of you that are here that are probably more retail or self-directed accounts, you may be trading more NQX, and for those of you that have larger accounts or institutional type trading, you might be trading NDX, but they track the same thing. And these two index options provide you with broad-based exposure to the Nasdaq-100 index, suitable for both retail and institutional traders. What I want to do is talk a little bit about what is the difference between trading index options versus stock or ETF options, because I know most of you here trade stock or ETF options, or familiar with trading stocks or ETF options. So from a trading perspective, they are very, very similar. However, index options does provide you some cost and transactional efficiencies. So number one, the biggest difference between index versus stock or ETF options is that index options are cash settled, which means that you don't have to worry about physical delivery of the shares. So if you're short some calls or puts, either you're outright naked to short calls or puts, or if you are trading a spread where one leg of that trade is short, you always have this risk of potentially either having to own the shares or have to deliver the shares if you're trading stock or ETF options. With index options, you don't have that risk. It's always going to be settled in cash, whether you're at a profit or loss at expiration. So you never have to worry about having enough money or margin in your account to cover buying or shorting the stock. Second of all, is they're European style, which means that there's no such thing as early assignment. You don't have to worry about being in a spread and all of a sudden being assigned on one leg of that spread. So there's no early assignment, cash settled. So it's really easy to manage from a trading perspective. There's also an additional favorable tax treatment. For those of you that are trading in a taxable account, when you're trading stock or ETF options, especially most of us trade options that expire less than 1 year from today, you're paying full capital gains on that trade, especially in a taxable account. With index options, you have a 60-40 tax treatment. So 60% of it is taxed as short-term capital gains and 40% is taxed as long-term capital gains, which means you have a lower effective tax rate on your trades. So potentially more profit for you if you are trading on a taxable account. And lastly, from a trading perspective, because it's an index, there's no corporate actions, there's no gaps in the charts, which is really good for technical analysis, because corporate actions like earnings, dividends, stock splits, things like that, these cause gaps in the stock, which makes it a little bit more difficult to do the technical analysis that you want to do. So by trading an index, a lot of times you have much smoother charts to look at, just makes the technical analysis side a little bit easier to manage. So let's jump over to now that I've done a quick introduction of the Nasdaq-100 index, and many of you have probably been following that over the last few weeks as we've been in this very, very volatile market, I want to talk a little bit about what is the value of technical analysis and what it can provide us with in terms of understanding how to trade and what direction to trade in. So before I start talking a little bit about technical analysis, can those of you that use technical analysis currently in your trading, please type yes into the chat window. And if you're not familiar with technical analysis, or if you don't use charts in your trading, please type no, just so I get a feel for the audience here in the room. Okay, so predominantly all yeses, but actually quite a few no's here. So for those of you that are not using technical analysis or not using charting in your trading, I want to talk a little bit about the value of technical analysis. And I think that even if you use other forms of analysis, specifically fundamental analysis, statistical analysis, or any other form of analysis, you should still consider taking a look at technical analysis from a timing perspective. So number one, technical analysis is really simple. We're trying to forecast future price based on the past history of pricing. So we're really looking at price history and taking from that history, trying to anticipate what is likely going to happen in the future. And this is really because we believe that markets are efficient and that price discounts all information. So by studying the price, we have a pretty good idea as far as what is happening in the past and what is likely going to happen in the future. And this is really based off of the fact that we don't believe that markets are random, that history may not repeat itself, but it certainly rhymes. That is the belief of a technical analyst, is that by studying history, I can see patterns that are likely going to recreate themselves in the future. And the benefit of technical analysis, in my opinion, above all other forms of analysis, is that through technical analysis, by studying charts, you get a sense of three very important things when you're trading. Direction, which is whether you think an asset's going to go higher or lower. Magnitude, which is how much higher or lower you think it's going to go. And lastly, timing, meaning how much time do you think it's going to take for that move up or down to happen. And this is really what technical analysis provides you with that some other forms of analysis may not do so. So for example, as a fundamental analysis, you might get a sense for direction, you might get a sense for magnitude, but you certainly don't get a sense for timing. So there are pros and cons to each form of analysis, but technical analysis really provides you with these all three things. And the key thing for me is the fact that I can apply technical analysis to thousands of instruments across every asset class. Meaning, if you're a fundamental analyst on a stock for stock trading, that knowledge is only applicable for stock trading, meaning you can't apply that fundamental analysis knowledge to futures trading or currency trading. You have to learn the fundamentals of that market. Versus technical analysis, I can apply a chart to any market, any asset class, any time frame, and instantly be able to get a view for direction, magnitude, and timing. And that's really the value of technical analysis that it provides that other forms don't. So number one, what I want to dispel the myth of with technical analysis is that a lot of people feel technical analysis is an art, it's not a science. But what I find is that technical analysis provides you with a very objective view on price. Granted, there are many ways to potentially view the same type of analysis, but if you stick to one form of analysis, it really provides you with an objective view every single day. If you apply a moving average, that moving average calculation doesn't change from day to day. And you can apply that moving average every single day and get an instant objective view as to whether the trend is higher or lower. Second part is that it's applicable to all instruments with a price. This goes back to my point about if you're a fundamental analyst, analyst, you can't apply that to other markets. Technical analysis, you can apply them to all different markets. And for those of you that are traders, you know that just studying one market many times is not enough. You have to look at other markets, or at least be aware of what's going on in other markets. If you're an equities trader, you should probably be aware of what's going on with interest rates, or what's going on in the fixed income markets. How can you do that? Technical analysis allows you to quickly pull up a chart for treasury bonds or corporate bonds and instantly get a quick view as to what's currently going on at that market. Not something you can do easily as a fundamental analyst. And lastly, because we all have different trading frequencies, some of us are day traders, some of us are long-term buy and hold traders. Other forms of analysis is not easily adaptable to different time frames. Technical analysis is, because you can look at a 1-minute chart, a 1-day chart, a 1-week chart, a 1-month chart, all different forms of time frames. You can apply the same level of technical analysis to any time frame. So regardless of whether you're a day trader or a long-term buy and hold investor, you can apply the same form of technical analysis. And that's really, in my opinion, the benefit of technical analysis. Now, there are some limitations to this, and it's really important to understand the limitations of this in order to be a successful trader using technical analysis. Number one, you have to understand that no form of analysis with technical analysis will work all the time. This is really why it's so important to understand when it works and when it doesn't work. And there's no such thing as a best strategy or an indicator. This is really one of the crux of, I think, one of the downfalls of a lot of technical traders is that they're constantly trying to find new strategies, better strategies, but you're searching for something that simply doesn't exist. There's no such thing as a strategy that works all the time. So it's better to understand that, understand when your strategy is supposed to work, when your strategy is not supposed to work, so that you're actually sticking to one strategy and not constantly changing from one strategy to the next, to the next, to the next. Because I certainly have been in those shoes before. When I first started to learn about technical analysis, I just wanted to learn about all different types of strategies, all different types of indicators, and I was constantly changing my strategy. And that's really when I was really not being consistent in my trading. Once I stopped doing that and focused on a few different strategies, understood when they worked, when they didn't work, that allowed me to really start to simplify my technical analysis and become a lot more consistent in my trading. So that's really the type of knowledge that I'm hoping to impart here today, is the different forms of technical analysis, understanding when they work, when they don't work, and then more importantly, how to leverage that into your trading strategy. So this goes to my point about spending a lot of time on technical analysis. I know many of you spend a lot of time on charts. I certainly did, but I think it's really important to understand is that your trades generate profits, not your technical analysis. Doesn't matter how good you are at reading your chart. That doesn't make you money. What makes you money is the trades that you make off the back of that. So when we're trading off of a chart, there's lots of different ways to trade that. So if we're bullish on the Nasdaq-100 index, what can we do? We can buy some stocks, we can buy the future, not FX in this particular case, but these are all examples of markets where you get symmetrical payoffs, meaning if you buy a stock or a future or a currency, you get dollar for dollar exposure. If the asset that you buy goes up by $1, you make $1. If the asset goes down by $1, you lose $1. That's what we call symmetrical payoff. And this type of payoff gives you unlimited reward, but on the same token, unlimited risk to the downside. That's what you get with the symmetrical payoff. And the limitation of this type of strategy is that you don't have any strategies to trade if you're simply neutral on an asset. So if you think that a stock or an ETF or an index is not going to move, what do? You can't really, there's nothing to do actually. So you have no neutral strategies to trade, and in many of these markets, you have limited abilities to short. Many times you may not be able to borrow a stock to short. So there's lots of limitations from that perspective. So these are all different ways that kind of limit your ability to take your analysis on the chart and be able to structure a trade around it to give you the outlook or the payoff that you're looking for. However, with options trading, you get an asymmetrical payoff. That means you have potentially upside or downside exposure with limited risk. And the key here is that options give you the ability to trade any direction, any magnitude, and any time frame possible. With stocks, futures, or FX, you effectively have a single strategy regardless of whether you're mildly bullish or extremely bullish, or if you think it's going to happen over one day or over 1 month or over 1 year. It's only one strategy. You just buy the stock. With options, you have a lot more options. And that's really the key of maximizing technical analysis, is to be able to apply the right strategy for the right outlook. And the key here is to limit your risk. So no matter what happens, we all know that technical analysis doesn't work all the time, and it only works some of the time. It's really important to understand that when it doesn't work out the way you expect it to, how you can limit your losses. And options really allow you to do that, is limit your risk on the trade that you're making so that no matter what happens, you have a defined amount of risk. And that's the key to success with trading. So let's start talking about different option strategies for technical analysis. Now I'm going to break this down into 2 categories, because these are the 2 major categories of analysis that you'll come across when you do your technical analysis. Number 1, when you do your technical analysis, every single time you should have a pretty clear sense of direction. However, with technical analysis, what's not always clear is the magnitude. Meaning if you're bullish on a stock, you may not know exactly how far it's going to go, depending on the form of technical analysis. So when you have a clear sense of direction, but you don't have a clear sense of how far it can go, that's really where buying calls and puts, when you expect a quick and fast move, is the suitable strategy. And if you're expecting more of a neutral or smaller directional move or a modest move, that's when you want to sell credit spreads. And when I talk about credit spreads, I'm talking about short call and put verticals. I'll break that down in the next slide for those of you that are brand new to these strategies. But if you have a directional view on an asset, but you're not clear as to exactly how far it can go, these are the 2 strategies that you can trade. And I'll give you some examples in the next few slides as to why these 2 strategies are best. And we'll go through some real examples in a few minutes as to why these 2 strategies are best when you have a clear direction, but not a very clear sense of magnitude. Second type of technical analysis that you'll come across is when you have a very clear sense of direction and you also have a very clear sense of magnitude. There are many examples of technical analysis where such as support and resistance levels, where you have a pretty clear idea as far as when you should enter the trade, and you also have a pretty clear target price as to where you think that asset's going to go to. And for these types of strategies, it's best to use debit spreads or long call verticals or long put verticals. So this is, again, when you're expecting a modest directional move in one direction or another, where you have a pretty good idea as far as how far it can move. So these are the 3 strategies, and it's really important to understand these 2 criteria. When you have a clear direction but unclear magnitude, or when you have a clear direction but a clear magnitude. So how to differentiate between these 2, I'll go through some examples so that becomes clearer. But before I do that, I just want to jump into just understand the best practices for each one of these strategies. Now, if you've traded calls and puts before, please type yes into the chat window. If you've never traded a call or a put before, please type no, just so I get a feel for how many or the trading experience, if you will, of the audience here. Okay, so I've pretty much got all yeses. I see 1 no, a couple of no's. So for those of you that are brand new to buying calls and puts, welcome to options. I hope this inspires you to consider taking a look at this as opposed to just outright buying the stock. But when you're buying calls and puts, you generally want to buy expirations that are at least a month or longer, because when you're buying calls and puts, time value or time decay is working against you. You want to minimize that to some degree by buying slightly longer dated options. And one of the ways to do that is by buying longer dated options that are greater than 1 month from expiration. And as far as strike prices, you always want to start with a slightly in the money strike. So whether you're buying a call or a put, you want to start with a 50 or 60 delta call or a put. That's usually a good starting point. Now, that's not saying that that's the best trade every time to make, but that's a pretty good starting point for most users if you have a bullish or bearish view on an underlying stock or an ETF or an index, and you're buying a call or a put on it. A more advanced strategy is a debit spread. If you've traded a debit spread, please type yes into the chat window, or no if you haven't. A debit spread is basically the same thing as buying a call or a put, but we're going to add an additional leg to it, which brings some additional benefits. So just like buying the call or put on a debit spread, you want to buy same thing expirations that are about 1 month or longer from expiration, and you want to do the same thing, buy a slightly in the money call, a 50 to 60 delta call, so that's identical to buying a call or a put. But now what we're going to do is we're going to sell an out-of-the-money call or put against that. So selling, let's say, roughly a 15 delta call or put against that, what that does is it brings in a little bit of income, and that causes an offset off the price that you have to pay on the long call. That means you reduce your risk, you reduce the break-even price on your strategy, and you're reducing the time value or the time decay on the whole strategy. So those are some of the benefits of trading debit spreads. Now, I don't have enough time to go into detail for each one, but we do have separate webinars in each one of these if you are interested in learning more of these strategies, especially if you're brand new. The third strategy is credit spreads. This is a bit slightly more advanced strategy. And there's generally two ways that you can trade credit spreads, but this is referring to short call or put verticals. For these types of strategies, you generally want to sell shorter dated options because you want to take advantage of that fast accelerating time decay. So usually selling 1 to 3 week expirations, specifically for index options too. 1 to 3 week expirations is sort of the sweet spot when it comes to selling credit spreads. Now, there's generally two ways that you can sell these credit spreads. Many index options traders will sell these very high probability, low credit credit spreads. This is where you're selling a pretty far out of the money call or a put, a 10 delta call or a put, and then you're buying back an even further out of the money call or a put, a 2 to 5 delta call or a put. We see a lot of these trade all day long on symbols like NDX. You know, these typically have probability of profits well over 90%, some of them 95, 98, 99% we've even seen. These are where you're collecting very small amounts of credits, but they have a very, very high probability of profit. They do come with a lot of risk. In my opinion, a slightly better strategy to trade, but again, this is simply just my opinion, is to lower that probability a little bit and get a higher credit, which means that you have a much better balance between risk to reward. You're still going to be risking more than what you're going to be bringing in as a credit, but that ratio is going to be much better balanced where you're selling roughly a 40 delta call or a put, so a put or a call that's fairly close to the current price, and then you cap the risk on that by buying roughly a 20 delta call or put against that. For these types of strategies, you typically see roughly about a 70% chance of probability of profit. So still a pretty high probability of profit, but when you're wrong, you're not losing, you know, the last 20, 30, 40 trades in a row off of a single losing trade. So that's, in my opinion, the better trade to make. But, you know, like I said, we see these high probability, lower credit trades trade all day long in these indices because these indices don't have gaps, right? Because there's no corporate earnings, there's no earnings that cause these huge gaps. So they tend to have lower probability of these making really big moves. And that's why a lot of people trade these very high probability credit spreads on index options. So now let's jump over to the fun part, chart analysis. This is really where we want to dive into some of the major categories of technical analysis. And I want to explain with each one of these, I just want to do a brief explanation on the technical analysis techniques. And then more importantly, what is the appropriate option strategies to trade with these different forms of analysis. So first off, I'm going to talk about chart analysis. This is really basic reading the price action, not using a lot of indicators or anything technical, just reading the charts and seeing what we see. So support and resistance lines are probably something that many of you are familiar with. Trend lines is really, in my opinion, just a variation of support and resistance. Support and resistance, in my opinion, should be horizontal. And then if you turn them on an angle, they turn into trend lines. But they're really similar. The idea is that they are effectively ceilings and floors. And the idea is that when it hits a floor, the price is likely going to bounce higher. When it hits a ceiling, price is likely going to bounce lower. And you can basically connect a bunch of dots to find where your support and resistance level is. So here's a Nasdaq-100 index back in 2000, a couple of years ago, when it was trading between a pretty wide range between 3,900 and 4,700. 4,700 being a bit of a ceiling and 3,900 being roughly a floor. And every time it hit that ceiling, it bounced off. When it hit the floor, it bounced higher. Until effectively it finally broke above that ceiling. And once a ceiling is broken or resistance is broken, it becomes support. So as you can see, once we broke above 4,700, it came back down, bounced off of that floor, bounced off, it came back down to that floor again and bounced higher. So this is really where you can use basic price action, nothing fancy, no indicators or anything like that, and get trade ideas and signals. So what I really want to talk about is how you can use these signals and what is the option strategy that you should deploy. So first of all, I want to talk about the fact that bounces off of a support and resistance line may or may not provide magnitude. What I mean by that is, as you can see here, when it bounces off support, you can target that resistance level. But a lot of times you may not be bullish enough to think that it's going to move to that resistance level. You might just think that it's not going to go below 3,900 or this floor. So there's two ways to view it. You can either view a bounce as, hey, this is bullish and I think it's going to go higher, or this is hitting support and it's not going to go any lower. And between those two versions, so if you expect a clear direction and a clear magnitude, the best trade to make here is a debit spread, buying a call or put vertical if you're bullish or bearish on a bounce off a support and resistance level. The other version, what I was talking about, where if it hits a floor and you simply think it's not going to go any lower, where you have a clear sense of direction, but you don't really have a sense for magnitude, you're just pretty sure that it's not going to continue going any lower, that's when you want to sell a credit spread. So this is really, the credit spread really allows you to take advantage of the fact that a asset is not going to continue moving in one direction or another. It doesn't really have to move anywhere at all. It can just stay where it is and you can still profit from that. And that's really the benefit of a credit spread, is that it really allows you to take advantage of a neutral move, something that you can't do if you're trading the stock or ETF. Next, I want to talk about breakouts and breakdowns. And I have some statistics to put along with this, but breakouts and breakdowns is really just a variation of breaking support or resistance. We certainly had a pretty big breakdown, in my opinion, recently. Here's a pretty big trend line. This is a weekly chart. Over the last year or so, as you can see, the Nasdaq-100 index went from about 6,400 to about 7,700, formed a double top, and then finally kind of broke this bullish trend line. Broke this bullish trend line at the same time it cracked the 50-week moving average while it formed a double top. So there's a lot of different chart analysis here that you could have done that said, you know, this index pretty much had a topping and is starting to correct lower. And as you can see, once it broke that support level or this trend line, you had a pretty nasty move to the downside. And I believe right around here is when we did that last webinar on how to hedge your portfolio using NVX and NQX. And I know that many of you here on this webinar today actually took some of that and was able to hedge your portfolio using that. So, you know, here's a great example of how to utilize index options to not only find opportunities to trade, but more importantly, potentially even hedge your portfolio. So some of the stats that I wanted to point out specifically regarding breakouts and breakdowns is that we looked at the Nasdaq-100 index over from 2000 to 2018. So 18 years of data. We looked at daily data and we looked at weekly data. And we wanted to see what is the breakdown of number of days and weeks when the index moved higher versus lower. And you can see very clearly there's a pretty big difference between number of days when the index moved higher. 54% of days and 54% of weeks the index moved higher versus only 46% of days and weeks the index moved lower. So clearly there's a bias right off the bat that there's a higher probability of the index moving higher versus lower. But the more important thing that I actually think here is the fact that the average positive move on the index was 1.06% on the daily, 2.2 on the weekly. But as you can see on the down moves, they're bigger, 1.16% on the daily and 2.42% on the weekly. So what this means is that it's more likely that the index will move higher, but on the chances that it does move lower, they tend to move a little faster. And because of that, that's really where we find that, generally speaking, when you're trading a breakout, these tend to have clear direction, but they don't really have a clear sense of magnitude. And breakouts typically don't move as fast. So that's why we generally use long calls to trade these breakouts. But breakdowns, because we have a template as to where a chart previously was, so in this particular case, when it broke below this moving average and this trend line, we have previous data to show us roughly where target prices can go. You know, the lowest target here is around 6,400, but there's a few different moderate targets in between, around 7,200, which was a support level here, around 77,000, which was a target level here. So on the downside, we tend to see more a clear sense of magnitude. So because of that, we can trade either long puts or debit spreads as to the downside. So when we're trading breakouts versus breakdowns, the statistics tell us that there's slightly different strategies that we can deploy for breakouts versus breakdowns. Next, I want to move over to lagging indicators, moving averages and Bollinger Bands, these types of indicators. Like I said, this is by no means an exhaustive list of lagging indicators. There are plenty of other ones. Many of you use channels and things like that. These are all forms of lagging indicators. These are indicators drawn on the chart. So moving average is probably by far the most popular one. And what's important to understand about these indicators is that they don't give you a sense of magnitude, generally speaking. When you have a moving average crossover, these are designed to give you an idea as far as how is the trend, what is the trend based on an average of what's going on historically. These generally don't give you a sense for how far something can go. And because of that, when you're dealing with chart overlays such as moving averages, these give you clear sense of direction but unclear sense of magnitude. These are where you generally want to buy calls and puts on a moving average crossover, or you can trade credit spreads because this is where you have a sense of direction but no sense of magnitude. So credit spreads many times, in my opinion, is a good strategy to trade on moving average crossovers as opposed to outright buying or selling or going long or short, which I see a lot of people do when a stock goes above its moving average, below its moving average. People like to get long or short, and sometimes that's not always a good idea. So that's why I always advocate on moving average crossovers and things like that. You may want to lean more so on the credit spread side versus outright going long or short. With Bollinger Bands, you do actually get a pretty clear sense of direction and magnitude, and because of that, you generally want to trade debit spreads in this particular case. And lastly, what I want to cover is a very, very, probably the most popular trading strategy, which is using leading indicators like RSI, MACD, or stochastics. If you use any of these indicators, please type them into the chat window. You know, whether you use RSI or MACD or William %R, type them into the chat window because I'm curious as to what type of indicators people use. But the one thing I want to clarify first and foremost is that regardless of which one of these leading indicators you use, they are all effectively measuring the same thing. They're trying to measure momentum. They're measuring them in different ways or different methodologies, but for all intents and purposes, they are there to manage or measure momentum. So my philosophy here is to keep it simple, meaning you don't need all of these different indicators. Like you don't need to use MACD, RSI, stochastics, and all of these because they're all trying to do the same thing. And a lot of times if you use multiple ones, you end up getting conflicting signals. So that's really why we want to make sure that we want to help you simplify when you're using these leading indicators. And the second thing I want to make sure people understand, as you can see here, I have a chart of a Nasdaq-100 index. I have an RSI, a 14-period RSI, very standard use of this indicator. And as you can see, if you just studied this indicator, you would have learned that if it crosses below 70, that's a sell signal, which you get a sell signal here, another sell signal here, and then you get a buy signal here. Those are the three signals that we got from RSI on this entire chart. And as you can tell, none of these would have done very particularly well because if you shorted the index here, you probably would have lost some money. If you shorted the index here, you may have made some money over just a few days, but the index went right back to where it was and even higher. So I want to make sure that people understand how to utilize these indicators correctly because when you're using these indicators, what you're getting a sense for is a clear sense of direction, but an unclear sense of magnitude. What I mean by that is when you get a sell signal or a buy signal from any of these indicators, it doesn't give you any sense for how far it can go. So when you get a buy signal on the RSI here, is it going to go up 10 points, 50 points, 100 points, there's no indication that the indicator is going to give you as far as magnitude. And that's really why it's really important that if you're going to use a momentum oscillator for your trading, you want to use them with credit spreads. Because if you get a buy signal, you want to sell a put credit spread. When you get a sell signal, you should use a call credit spread. And that's really, really important because none of these indicators give you a sense of direction. And for those of you that trade using these indicators by trading stocks, you should keep that in mind, because if you're buying a stock off of a buy signal on an RSI, when do you get out? What's your target price on that stock? You don't really have a good sense for that. And that's why, in my opinion, buying or outright going long or short a stock off of one of these momentum indicators that give you a buy or sell signal is not the optimal way to trade them. Credit spreads really allow you to simply say, well, this is oversold, so I think that it's not going to continue going any lower. Selling a credit spread will effectively get you paid as long as the stock or index doesn't continue to move any lower. And that's what these indicators tell you, is that momentum has reached an extreme, it's likely going to reverse, and as long as it just doesn't continue going any lower, you can make money by selling a credit spread. You can't make money trading any other strategy. So that's really why I want to make sure people understand the benefit of momentum oscillators, because it's the most popular strategy that I know people use, but I'm not sure that everyone's using the correct trading strategy off of that. And credit spreads really allow you to maximize these momentum indicators. And lastly, what I want to do is just provide some thoughts as to kind of some strategies that historically have produced some pretty good results. And that's really using leading and lagging indicators combined with each other. Now, you don't have to use many of them, and it's actually better to use fewer of them. And a strategy that I want to leave with you guys here, as you can see, I have the same chart on the Nasdaq-100 index. I have the stochastic indicator here. If you follow just the pure stochastics, you would have gotten a lot of different false signals. You would have shorted it here. Maybe that would have been a good trade. You would have shorted it again here, which would not have been a good trade. You could have shorted here again, which would have been a bad trade. Same, you could have bought here, which would have been a good trade there, but a bunch of false signals. As you can see, there's a lot of false signals on a lot of these trades. So how do you actually filter them out? And that's really when you use the combination of leading and lagging indicators that give you the benefits of both worlds. And the key here is that you want to trade with the trend, meaning if you only want to look at buy signals when the stock is trending higher, then you can use your moving average to figure that out. So here's a 50-period moving average and a 20-period moving average. You can use the two in conjunction with each other. One's a long period moving trend indicator, one's a short period trend indicator. But as you can see, from my eye, out of all of these trades, there's only two signals that were valid, and these are these two buy signals. And the reason I'm going to say that is because that's the only two signals where the buy where the signal and where the leading and the lagging indicator lined up with each other. So here I got a buy signal when the asset was above the 50-week moving average. Same thing here, when I got the buy signal, it was above its 50-week moving average. I would have ignored all of these sell signals because it was above its long period moving average. I don't want to trade a short trade in an uptrending market. Conversely here, if I had bought on this buy signal, I would have lost money, because here, as you can see, the trend changed. The trend turned from positive to negative. So trade with the trend. That's how you're going to be able to get the best of both worlds, to be able to use your leading and lagging indicators combined with each other to filter out the noise and get to the high quality signals, which is what you're really looking for. Keep in mind that this does filter out a lot of the signals, but that's really one of the benefits of using technical analysis, is that, when you're trading, and Warren Buffett said this the best, in my opinion, is that there's no such thing as balls and strikes on Wall Street. You can wait for the fat pitch, and the technical analysis really allows you to do that, is wait for the fat pitch. Only trade when the leading and lagging indicators line up. So this is what I call trading with the trend. This is not by any means the only strategy that you can trade, but this is one strategy that's really simple that most people can follow. Doesn't require a lot of indicators, doesn't require a lot of knowledge of technical analysis. It's really simple. By combining your leading and lagging indicators, your lagging indicator is going to provide you with the overall trend, And your leading indicators, such as your RSI, MACD, stochastics, any of these leading indicators is going to provide you with your trade signal. And the example here, again, is that the NDX, in this particular case, is trading above its 50-day moving average. So this is a bullish trend. So when it's trading above its moving average, we consider this in a bullish trend. And what we do is we only trade the bullish RSI oversold crossover signals. So the buy signals using RSI, only trade them there. And what we do is we basically ignore all the bearish RSI signals because the trend is bullish. And when it reverses, when the index is below the 50-day moving average, that's when we only look at the bearish signals and we ignore all bullish signals. So this is a simple way that you can trade with the trend by using two simple indicators. And this helps you really reduce the noise. You don't have to look at all these different types of strategies, all these different types of indicators. And it really doesn't matter which one of these indicators you use, because I get that question a lot. Do I use RSI, MACD, stochastics? It doesn't matter which one you use. As long as you use one that you use day in and day out, that's the best one. Find one that you're comfortable with, find one that you like, and stick with it. If you're using different indicators every single day, that's when you're going to get different results. So when you're using these types of trend following methodologies, that's really when you're going to be able to find higher probability, quick directional moves like the two examples that I showed you on the chart before. And only in these examples do we find that using leading and lagging indicators can you use debit spreads. So like I said, when you're using these leading indicators, I generally find that credit spreads is really the best strategy to use. But when you're trading with the trend and you're able to find these high quality signals, they don't come very often, but when you do, that's one of the few times when you can use these debit spreads because you're expecting a quick, fast move in one direction or another. You're trading with the trend. You're finding that an asset is temporarily oversold in a bullish trend or temporarily overbought in a bearish trend. That leads to these high probability, quick directional moves. And for that, you want to trade debit spreads. And lastly, I just want to leave you with a few tips. You know, working as a market strategist over the last 13 years, I've learned a few different things, and I've worked with clients from all different types of backgrounds. Number one, price is by far the most important indicator. Sometimes people get so overwhelmed by all the indicators on their chart, they forget to look at your price. Look at the price first. That's your most important indicator. All the information out there in the world is first reflected in the price. All the indicators that you can add onto the chart is just for confirmation, but chart is first and foremost. Number two, use fewer indicators. I suggest you just use one from each category. If you're going to use moving averages for your trend, select just one or two moving averages. Don't put 10 of them on your chart. If you're going to use RSI or MACD or stochastics or any of these momentum indicators, don't use 3 of them. Use only a single one because you don't need 3 of them. They're measuring the same thing. Just pick one that you like and stick to it. Third of all, it's really important to understand your strategy fundamentally. If someone told you to buy on an RSI buy signal, understand why you're doing that, because that's really that's how you're going to be able to stay consistent. Because if you understand why your strategy works, then you're going to be able to identify when it's supposed to work and when it's not supposed to work. Because we all come across times where our signal just provides false signals trade after trade. So how do you stay with that? How do you stick to that? And it's really important to understand. As long as you understand when your strategy fundamentally works, that's going to allow you to stick to a strategy even when you have a few losing trades in a row, because you understand, hey, this is not the right environment for the strategy to work in. I understand that. I'm not going to be too worried that I have a few losing trades. I'm going to stay consistent with my strategy. And that's really the last part. If you're going to use a 50-day moving average today and a 200-day moving average the next day and RSI signals the day after, you're going to get inconsistent results. Find one strategy and stick to it. That's really the key to being consistent with trading. So lastly, what I want to do is I want to jump over to options play. I only have a few minutes left, but I do want to show you the power of how to utilize option strategies with what's currently going on at the markets. So for those of you that are brand new to options play, welcome. This is a tool that's designed to make your options trading as intuitive, as easy as possible. And the reason we built this is because pages like this is not really conducive for people to find the right option strategies to trade. You can be the best technical analysts in the world, but when you're bullish on a stock and you're looking at pages like this or an index and you're looking at pages and pages like this, it's really easy to get lost and figure out where to start. So you can have the best technical analysis in the world and be very confident that you think the index is going to go higher, but how do you pick the right option strategy? And that's really where options play comes in. This is designed to allow you to quickly find bullish and bearish ideas instantly on any index like the NDX. So today, what I want to do is I want to take a look at the chart that we've been showing you before. This index, as many of you know, the markets have sold off pretty heavily over the last few weeks. We had a first wave of sell-off. Market came back, bounced a little higher, but sold off again pretty heavily. In the last couple of days, we've got to bounce back just to around roughly the 20-day moving average. So from my perspective, I think that there's still, because of the fact that we are clearly, the long-term trend is both the 50 and 20-day moving average is it's trading well below the 50 and 20-day moving average. This is clearly in a bearish trend. And the fact that it's near that 20-day moving average tells me that there's a possibility, in my opinion, that this can continue moving lower. So we talked about, breakdowns or moves lower tend to happen faster. So we can look at historically, where the index has been to give us an idea as far as not only sense of direction, but also magnitude. So where can this index head to? 6,600, 6,500, 6,400? I think these are fairly conservative targets of the downside if you're bearish on this. And that's really what our tool is designed to do, allow you to quickly structure all different types of trading so that you can say, I can buy a put for $23,000 or I can buy a put spread for $13,000. And for those of you trading smaller contracts, looking at NQX, which is, again, the same index, but 1/5 the value. So as you can see, buying a put here, instead of costing $23,000, only costs you $4,000, and buying a put spread only costs $3,700. So this is really probably a bit more geared a bit more for this specific webinar. And what this allows you to do is say, well, if this goes back down to its previous low, which is around 13.15 or so, how much money do I actually make from each one of these strategies if I bought a put? Because if you're looking at a page like this and you're saying, okay, let me look at this slightly in the money put. Let's say I buy the 7,000 put. How much money do I make if it goes down to 6,500? You can't really figure that out from this page. But our platform, if you say that I think it's going to go down to a certain level, it tells you exactly how much money you'd make. So if you bought the put, you make 112% return. If you bought the put spread, which is the debit trade, you make 183% return. This allows you to understand not only your potential rewards so that you can decide, is there enough reward for the potential risk that I'm going to take? And the risk is that what happens if the index bounces or roars back higher? If this does go higher, it can go up to 1,500 or maybe even, let's say where it was. The 20-day moving average is 1,420, 50 days, 1,470. So let's say it's going to go back to 1,475, 50-day moving average. As you can see here, you lose $4,900, you lose $3,700. And you weigh that against what happens if it goes down to that 13.15 level. How much money do I make? Well, I can make $6,900 if it does go down that. So here I'm going to make roughly double the amount that I'm risking if I'm right versus if I'm wrong. So in my opinion, that's a pretty good risk reward because I'm thinking that I have a slightly better than 50-50 chance that I'll be right. And if I'm right, I'm going to make $6,900. If I'm wrong, I lose $3,700. Those are the types of odds that I want to have as an options trader that I don't get to use if I'm just outright shorting. First of all, you can't short the index. You can short the future. You can short the ETF. But I certainly am not going to get this 2-to-1 risk-reward ratio by shorting the ETF or the future. The option is really the only strategy that's going to allow me to do that. And conversely, what happens if I'm bullish? What happens if you think the Nasdaq-100 index is going to come right back? You're not too concerned about all the trade wars that's happening. You think corporate earnings are going to come back and bring this market back to life? Let's take a look at that. So what are a few strategies that we can do? Number one, we said that we can buy a call, we can buy a debit spread, and we also talked about selling a credit spread. So let's take a look at those three strategies. I'm going to sell a shorter dated credit spread. Let's say I'm looking at about a 50-point credit spread. I'm not going to get into the mechanics of selling credit spreads on this particular webinar. I simply don't have enough time. But this is really a demonstration of how flexible this platform is. I can instantly set up a credit spread next to a call, next to a debit spread. And and compare the three side by side. So if I think the index is going to go back to its, and actually before I do that, let's actually make sure that I'm risking the same amount of money. Let's say I'm willing to risk $5,000 on this trade. So let's compare this apples to apples and say, if the index, which is currently around 1413, goes back up to 1420, which is the 20-day moving average, as you can see here, only the credit spread makes you money. The other two strategies you're going to lose money on. So this allows you to quickly say, hey, based on my technical analysis, I think that it's going to move slightly higher. I don't think it's going to move a lot because it's had this huge move over the last few weeks. I think volatility is going to die down a little. How can I trade this? This tool allows you to quickly compare three strategies and definitively know which strategy gives you the best return. And more importantly, what happens if the stock or the index moves significantly higher? What's the better strategy here to make here? So what if it goes back to its 50-day moving average, 1475? As you can see here, I make $1,500. Here I make $1,500. Here I make $1,700. So here, that's really where the two are, or the three strategies, in my opinion, are actually quite similar. So if you think it's going to go back to its 50-day moving average, all three strategies give you very similar payoffs. But if you think it's going to go any further, as you can see, that's where things change substantially. If you think it's going to go up to 1530, which is where it was before this major sell-off, here, I'm still going to make $1,500. So this is where the credit spread's not the most optimal strategy, but the other two strategies pays me $7,000. So certainly if I'm very bullish on the index, I'm probably going to be looking at these two strategies here on the right. And this tool really allows you to compare all different types of strategies. But the most important thing here is making sure that you go back and review what type of technical analysis do you do? Do you use chart patterns? Do you use indicators? Do you use chart overlays? Make sure that you're applying the right form of options trading for your views. That's what's going to give you the maximum profit potential on your technical analysis. We spend a lot of time analyzing the charts. Let's make sure we maximize our trades as well. And that's really what I hope this webinar was able to teach you guys here today. So with that, what I want to do is I want to open this up for Q&A and leave this slide up for those of you that are brand new to Options Play. If you want to take a look at the tool that we just showed you, you can get a free 30-day trial, as well as a bunch of options education webinars similar to this on how to utilize our tool and daily option trading ideas. And you can find that at optionsplay.com. So I want to thank everyone for taking the time out this afternoon here. And at this point, I will open this up for Q&A. If any of you have questions, please type them into the chat window, and I'll try to answer as many questions as I have time for. So Paul's asking why credit spread with a call as opposed to selling naked call. Great question. So indices are very, very large value indices. So imagine if you had to sell a naked call on an index or a stock that's trading at $1,400. Think about how much margin requirement you're going to need to do that. You're going to need a lot of money to sell a naked call or a put. A credit spread allows you to effectively do very similar type risk profile, but by buying back that further out of the money leg, you're going to be able to significantly reduce the amount of money it requires to trade that trade. So that's why we always trade credit spreads versus outright selling naked calls or puts. If you have the capital to do that, by all means, you can sell naked calls or puts, but most people do not have the capital to do that. What does the number and the strategy mean? Great question. So the question was, what does the numbers here mean? So the numbers refer to the risk to reward, meaning how much reward, meaning how much green do you have on the strategy versus how much risk do you have, how much red do you have on that? And we're basically comparing the potential risk versus the potential reward and giving you a single number that allows you to compare different strategies, because a call has unlimited reward. How do you calculate the risk reward of that? You really can't. That's why we created the Options Play score. So you have a unified metric to give you an idea as far as how much balance is there between risk to reward, and allows you to compare different strategies side by side. Greg, you're very welcome. I really hope that this webinar helps you guys better understand technical analysis, and more importantly, better understand how you can profit from technical analysis, which is really applying the right strategy for your form of analysis. If the trade doesn't go in the analyzed direction, when and how do you close the trade of a credit trade? So in my opinion, when you're trading these types of credit spreads, you have a predefined max risk and max reward. You should be comfortable with those numbers when you get in, meaning comfortable risking that whole amount if you are wrong. So generally speaking, we always tell users you should cut your profit. You should either take profit or cut losses based on your views of the underlying. Meaning, if I'm bearish on NQX because I think that it's approaching its 20-day moving average, I think it's going to go back down to 13.15. If it actually breaks above its 20-day moving average, that's my indication of getting out. It has nothing to do with where the option is trading, how much money I'm making or losing on the option, because my trade was entered because of technical analysis. And if my analysis doesn't work out, that's when it's time to get out. Where are you looking to take options play in the future? Great question. So I'd love to answer that question, but I don't want to get off topic here. I want to focus our questions on technical analysis and options. So please, Ralph, send me an email at info@optionsplay.com, and I'm happy to talk to you about kind of what we have planned in the future. Are all ETFs treated like the 60/40 tax treatment? No, only the index options have the favorable tax treatment. That's really one of the huge benefits of trading these index options. When you're trading the ETFs, they are taxed at full capital gains if you're in a taxable account. Only index options give you the favorable tax treatment. So please take a look at that because only index options provide that benefit. Any other questions regarding any of the things that we went over here today? Spencer, thank you very much. I really appreciate that. Eric and David, I really appreciate that. Thank you so much. Great question. There's a question here is, how does this compare to buying the Qs or the SQs? So from an index perspective, they are attempting to track the same thing. Just the Qs are an ETF that's listed on the index. Like I said, there are some benefits to trading NDX versus the Qs. They are obviously different contract sizes. So that's the thing that you have to figure out as to what's best for you. But from the benefit of trading index options, which tracks the exact same thing as the Qs, is that you get the cash settlement, which is huge for those of you that are constantly getting in and out of trades. You don't have to worry about physical delivery, especially if you're selling credit spreads and you have the risk of potentially having that short leg being assigned. Cash settlement really makes managing expiration Fridays, in my opinion, much easier because you don't have to worry about, hey, if I don't close this out, am I going to end up, am I going to need the margin to buy the stock or short the stock? You don't have to worry about that. It's all cash settled. There's no early assignment because everything is European style. And most importantly, you have the favorable tax treatment. So if you're trading the same thing, why not get the favorable tax treatment? So those are, in my opinion, the reasons why you should consider taking a look at the index options if you are already trading the Qs as an ETF option. Bill, if I join Options Play, are the past seminars available? Yep, every single one of our previously recorded webinars are available on our YouTube channel, including this one. We will be posting on our YouTube channel in the next day or so. Serge, you're very welcome. Thank you so much. Ron, do you ever consider IV or IV rank in your analysis? So I personally don't. And the reason for that is really because, when you're trading something like this, by far, delta is your largest risk. Meaning, as you can see, when the index goes up and down, there's a huge shift in your P&L versus your changes in volatility. Even the volatility decreases by half. As you can see, the impact to your P&L is minimal. So meaning if you're going to use implied volatility to decide what you trade, you are, in my opinion, only looking at a very small sliver of what's actually impacting your P&L. Whether you should trade a debt, and a lot of people, what they'll do is, when implied volatility is high, they'll trade a credit spread, and when implied volatility is low, they'll trade a debit spread and use that as the vehicle. But as you can see from my analysis, you should use the form of technical analysis to derive whether you should trade debit versus credit spreads. Implied volatility is certainly may give you an edge, but that's all it is. It should not be the ultimate. It should not be the thing that you use to decide which strategy to trade. If you want more information on that, I'm happy to dive into that, but that's a little beyond what we're here to talk about here today. So if you have any questions on implied volatility, please send me an email at info@optionsplay.com, and I'm happy to answer those questions. Vincent saying, I've always traded QQQ. Is NDX or NQX the symbol on the trading platform? Yes, NDX and NQX is the symbol on your trading platform. Is NQX considered an index vehicle? The NQX, yes, is an index option. The NQX is the exact same thing as the NDX option. It's just 1/5 the value, which is better suited for retail. So if you have a smaller trading account, you should consider taking a look at NQX. If you have a larger account, you should consider taking a look at NDX. Ralph is saying that, are we only considering NQX? Thinkorswim says no NDQ. There's the symbol is not NDQ, it's NDX. It's NDX and NQX are the two symbols. NDX and NQX, so not NDQ. I know there's a lot of names that are going here and sometimes a little confusing, but NDX and NQX. Irina, to your question about StockTwits, please shoot me an email separately, info@optionsplay.com. Happy to talk to you about StockTwits. Any other questions? If there are no other questions this afternoon, I just want to thank everyone for taking the time out this afternoon to listen to us and talk about technical analysis. I really hope that you guys found this useful. Raymond, if you don't mind typing in your question again, I'm sorry if I missed it. Alvin, thank you so much. I really appreciate it. Like I said, I want to thank everyone for taking the time out this afternoon. I certainly want to thank Nasdaq for having me here to talk to you guys about this great product and how to utilize it for trading. I certainly have been illuminated myself in building these educational webinars on trading these products. And it's been a great journey here. And I want to thank the guys from Nasdaq for having me. I want to thank everyone for taking the time out this afternoon and coming to these webinars every Thursday with us. So I'm really excited to show you guys, and hopefully you guys are able to see the value in a new product like NDX, or more importantly, NQX, especially for those of you in a smaller account. Raymond, I'm happy to address that. Just send me an email at info@optionsplay.com. It's just an issue with our data provider. Any last questions before I sign off for today? Is it worth trading NQX in IRAs just to avoid early exercise? Vincent, why don't you send me an email at info@optionsplay.com, because I want to understand what exactly you're trying to, what the strategy you're trading is, and I'd be better able to answer your question then. Serge, thank you for the feedback. I certainly will consider that for future webinars. Yes, it is possible to get the slide deck. We will be sending out both the slide deck and the recording to everyone afterwards once we're finished processing it. So with that, I want to thank everyone for taking the time out this afternoon. I will see everyone next week, and I hope you guys have a great, great afternoon.